I don't normally do this, but when I saw this headline, I thought quite a few people would be asking my thoughts. If you don't know what I'm talking about, it's this. Sydney housing values are falling at the fastest pace since at least the early 1980s. To make matters worse, interest rate increases have started to take bite, concern the market, and the Reserve Bank has flagged that they're potentially going to increase rates in just a few weeks' time, giving us a pretty clear signal that mortgage repayments are about to get a lot more expensive. So today, I'm going to cover the biggest question we're getting asked at the moment. Is now a good time to buy? And is the property market finally going to collapse this year? So today, let's talk about the current state of the property market. Let's talk about how much prices could fall and if the property market could be heading the way of the stock market, all supported by data and facts. If you enjoy the videos we make on our channel, please hit that like and subscribe button. It means a lot to Nathan, Joshua, and I. So to understand why some of the markets, including Sydney and Melbourne, are starting to soften out and fall, let's have a look at some of the key factors that are influencing this. The biggest influences on property prices include the demand from new buyers, the supply of new housing, and the average discounting from sellers. So sales volume, that's the dollar amount of sales, is starting to ease from recent highs. And while national sales are up annually, sales estimates over the 3 months of July were 16% lower than the same quarter of the previous year. And clearly you can see from the data there that Sydney sales are already down 13%. Melbourne's still hanging in there, all right. Looking at median days on market, in the 3 months of July, the median days on market was 32, up from the crazy lows of 20 days over the 3 months of November. Now, median days on market is the average time it takes to sell a property. So if it's taking longer, people are probably less interested and potentially have to take bigger discounts. So like you can see there in Sydney, last year, this time, the median day on the market was 24. Now it's sort of 35. Melbourne, it's a similar case. And I guess like over the longer term, since kind of 2018, obviously when the sort of combined capital median days on market was over 55, we're still significantly below that. But it's chances are that's going to keep creeping up over the next couple of months. The vendor discounting similarly is a good indicator to get a sense of how much sellers are discounting their properties values. And obviously in a hot market, there's not a lot of discounting or vendor discounting because you've got 3 buyers offering contracts and sometimes they're offering over what you expect. And that's what we've seen a lot of over the last couple of years. This is starting to sort of go back to kind of where things were historically. So in Sydney last year, there was only a vendor discount or seller discount, of 2.8%. That's getting closer to 5%, 4.8%. And we can probably expect that to increase. So I guess if you are in the market, that means that you can expect to be able to sort of negotiate with the sellers a little bit more because it's becoming more sort of a buyer's market where you can have an opportunity to do that and not just miss out because the property sells in a matter of days. Interestingly, at a national level, the total listings are gradually rising, but they remain below the average for this time of year. The total stock, so the total properties being advertised, are 24% below the 5-year average. And so this is a thing that is definitely going to be impacting some of these markets, including Sydney and Melbourne, even potentially Hobart, I guess, looking forward, is that with more listings, so there's more properties for sale, it's giving buyers more choice. And if there's sort of fewer buyers, people can have more choice. Potentially the sellers are going to have to discount their properties because there's going to be 2 other houses that are the same thing. And the only difference is going to be the price, and the one that goes lower is going to sell first. So this is going to be an interesting one to watch, and definitely will contribute to the softening of some of those markets, especially in Sydney and Melbourne. Speaking of listings, the next item that really influences the property market is the amount of properties for sale, the amount of stock available, and even the new constructions. So as we've reported before on this channel, there's a lot of issues in the construction industry, not only from the raw materials coming from overseas and getting processed, it's also labor shortages and potentially builders going bust. So I've got a bunch of videos on that if you haven't seen. But the so what of that is it means less houses and less properties being built. We have to rely on all the existing stock. So there's less kind of supply coming in there. Potentially, maintaining demand. So as far as total unit commencements, they were down 6.5%, seasonally adjusted in the March quarter, and house commencements were down 11%. So less houses are being built, and definitely the pipeline moving forward based on the amount of builders going insolvent and going bust doesn't look good. So this isn't going to get fixed anytime soon as far as the sort of supply of new housing, and it's going to potentially cause some big issues as far as sort of property supply over the next few years, and even potentially put a bit of a sort of floor under some of these price drops in areas. According to the Property Council of Australia, as net overseas migration and the economy recovers, new housing demand will outstrip supply. So the projected in this report, the report says that between 2025 to 2030, 2032, Australia will find itself 163,000 houses short. That's a deficit of 20,000 homes every year. And it's not getting fixed. So that's an interesting one that, because houses aren't getting built, because the population is growing, both organically and from overseas migration, it's going to potentially put more pressure and more sort of support for housing prices, which is another point and probably another flow-on effect in why Sydney and Melbourne were some of the first to kind of come off. In amongst other things has been a lot of the migration that's sort of gone, definitely during the COVID time. From Sydney and Melbourne, each city lost around 32,000, Sydney 31,232, Melbourne 32,166 in the 12 months to March 2021, as people relocated to regional areas, to obviously Brisbane and Queensland, and the net gain was to some of these other cities. But the X factor, I guess, as well with overseas migration is that with the borders opening from February 2022 this year, there's obviously a lag time for visas and different things. Sydney and Melbourne are going to be the big beneficiaries of that, because based on data from the Reserve Bank, Sydney and Melbourne in sort of 18, 19 and 2021 were the beneficiaries of pretty large changes, pretty big chunks of sort of population growth, mostly from net overseas. So not necessarily, that's the green lines there. That's from people coming overseas. Whereas you can see during COVID, there were none. There were kids still being born, but the migration went negative, and in Melbourne actually people went back overseas to live. So if that sort of resumes, then potentially it's going to be a fairly big chunk of overseas migrants that are moving overseas. I think the government allows about 200,000 net migrants to come in a year. A fair chunk of those will move into Sydney and Melbourne, because that's sort of generally the first port of call. And it'll be interesting to see how that's going to potentially, I guess, give underpin and help those markets with giving more buyers and sort of creating more demand in those areas. So that's that point. The other one is also on the rental costs. So a trend that we've noticed over the last couple of weeks, and definitely different to probably what it was like last year, where it was all first home buyer, owner occupied sort of demand. The market's tipped a lot, where now people are investors and wanting to invest and looking back in the property market there, because they're not getting sort of priced out and can actually get a decent yield. And I think this is also pushing a lot of buyers potentially to look at markets outside of Sydney and Melbourne. Although, as you can see, like the rental change, rent across Australia is 9.8% higher over the year to July. Sydney was 10% up 12 months to July 2022. Sydney's 10%, Brisbane's 12%, Melbourne 8%. But we're definitely noticing a big shift where investors, I guess, are seeing potentially more value in some of the cities outside of Sydney. In Melbourne, in Sydney for 500,000, you get a studio in inner city Alexandria potentially, or in the city. Whereas in Brisbane, you potentially get a house in Springfield, or Springwood, for 500,000 that you could sort of rent out for $500 a week and get a decent return. So there's definitely a bit more of a push there. And this is still displayed in the rental yields. In Sydney, 2.8% versus sort of 3.6 and potentially higher sort of in Sydney and Brisbane. And potentially the rental, I guess, as rates go up, will continue to get pushed, forward and help increase that, because it's been pretty widely publicized that the rental market's in not a great shape. And I guess because there's not being new houses built on the rental side too, there's not more places to live. And, that's a bit of a fine balancing act where it's going to sort of push more people into, it's not going to make it easier, I guess, is the point there. So it's all, things to be considered, because it's going to cause issues. And then on interest rates, it's really divided. No one really knows what's going to happen as far as the future there over the next few years. All the banks were saying rates were going to keep going up for the foreseeable future. Now we've seen several of the banks, even Macquarie most recently, reduce their 2-year and 4-year fixed rates, saying potentially if it really sort of shocks the economy, the Reserve Bank could start cutting rates a lot sooner than sort of initially forecast. If you're doing your figures, I guess be as conservative as you can, sort of factor in there. And I guess even if you're renting at the moment, you really need to be factoring in probably another 10-15% rental increase. We've been sort of hit up by several clients this week. I had someone that was renting in Sydney, and their rent went from sort of $350 to $580 a week. So it's obviously a lot more than 10%. So I guess on both sides, you just need to be sort of provisioning and sort of saving a bit of extra money there to make sure you're covered. I covered in my video last week, is now the right time to buy? Literally no one knows. And, how important is timing? I guess over a long enough time span, it genuinely doesn't matter because no one's genuinely going to be able to pick the exact bottom of the market. Like I quoted, Warren Buffett last week. He doesn't try and time the market. He sort of makes his own decisions independent of that. And I think that's the best way to do it. If you're thinking about getting into the property market, just doing A and B. If I continue renting, how much it's going to be if it goes up by 10%? If I get a mortgage and interest rates go up by 1%, 1.5%, what are my repayments going to be? And work out what's going to be best in your situation. If you do need help for finance, if you need any help with buying your first home or investment properties at Hunter Galloway, that's what we do. We'd love to help you out. So hit us up at huntergalloway.com.au. Until next time, see you guys.